Good morning, traders. My name is Timothy Hellberg. I'm a professional trader since over 12 years back, and today I'm bringing you a market report for week number 20 in collaboration with IMG FX, the people's broker. So let's jump right into it. Before we do, let me just remind you that it's not a recommendation to buy or sell anything. You should always do your own research. This is just me using my experience and my knowledge, dissecting the market and giving you some tips on how you can move in the upcoming week. If you want to read the full disclaimer, you can pause the screen. If don't, let's jump into the agenda for today. So we'll start out by taking a look at the economical calendar, what events we have in the upcoming week. Then we'll talk a little bit about market sentiment, the current sentiment and potential shifts to look for. And then we'll talk about last week's calls, where we had a mixed bag of results. We'll talk a little about Bitcoin that has a structural change. We'll talk about gold, where we have a falling knife that you might want to catch. And then we'll end off with some actual, just straight up trade setups in euro, pound and pound yen. So if we start by looking at the economical calendar, the week will start pretty slow. We got some news out of the UK, but that's not something huge. During the night we also have monetary policy meeting minutes from Australia, which once again isn't that huge. We have retail sales from the United States, which has the retail sales is the kind of news where it has to deviate a lot out of the expected figures for it to move markets, so don't expect fireworks. And then we have Fed Chair Powell speaking, which of course always is interesting. We also have another FOMC member speaking, so these can always give some good insights into the Fed's upcoming decisions. Then heading into Wednesday, we got wage price index for the Australian dollar. Well, same thing there, has to deviate a lot from the expected figures to actually move markets. CPI, however, from the UK, that's a big inflation figure, so definitely worth keeping an eye on, especially as we will focus quite a lot on the pound in terms of the trade setups today. So if you will be in similar trades or the actual trades that we talk about today, then it could be a good idea to obviously keep an eye out on the macro environment for the pound. Then we have CPI for the Canadian dollar, which could also obviously be market moving as it is a good inflation reading. Thursday, unemployment change and unemployment rate for the Australian dollar. Now, I always highlight this one because for some reason this has a tendency to more often than other countries deviate quite a lot from the expected figure. I have had much more times in the Australian dollar where this has moved the market pretty heavily during the night. As I'm in Europe, this is the night for me. It has moved the market pretty heavily due to it being a very different number from the expected one. So if you have Australian dollar exposure, this is really a data release to keep an eye out for, because it can deviate quite heavily. And that's pretty much it. Not the heaviest week in terms of data. Obviously, we still have any kind of news about inflation, stagflation, etc. But I think this week is going to be like last week, where the market was really dictated by sentiment, especially risk sentiment. So we're talking risk on or risk off. And we really saw that in the last week's market, and I think that will dominate the upcoming market too, as we don't have a super significant economical calendar. So with that said, let's jump right into the market sentiment. And as you know, we like to start by looking at the VIX. So looking at the VIX, this is the daily chart for the VIX. We are slightly elevated in the VIX. We usually talk about the 30 level being the line in the sand for the VIX, and we are jumping around that level. As I mentioned a couple of market reports ago, I expected this to move higher, and it has. We are currently keeping well above all the significant moving averages, the short-term adaptive moving average. We're keeping above the 100-day moving average. We're keeping above the 200-day moving average. So it's we were seeing increased volatility, which is not that surprising at all. And risk sentiment last week we were really having a quite heavy risk off going into the markets. But as we moved on in the week, I started highlighting different levels in the S&P. So why does the S&P matter? Well, the S&P is the largest stock index in the United States, which makes it the largest stock index, so to say, in the world, because this is the number one stock index that all traders, all institutions keep an eye out for. It's the number one risk gauge, etc. So everybody watches the S&P 500. Now, when the S&P starts getting into a certain level of decline, then we have a case for it entering a bear market. So a bear market would have been fun, but that's not what we are talking about here. And something that I started highlighting from a structural perspective was that going on the weekly chart for the S&P is that looking at historically in the S&P, anytime it has touched its 100, it has broken its 100 weekly moving average, it has, as fast as the upcoming week, broken down to the 200 weekly moving average. These are all the yellow highlighted ones, with the only exception being in 2015, where it broke the 100 weekly moving average, moved back above, and it took around 5 months before it actually made a run towards the 200 weekly moving average. Otherwise, it has always worked in the upcoming weeks. So with that said, when we were looking at where we were in terms of in the market right now, we have broken the 100 weekly moving average, and we closed the week below it, right? We closed below the 100 weekly moving average. So with that said, there is statistically a very big chance for the S&P to make a heavy run to the downside towards its 200 weekly moving average, which would be another over 11% down from where we are now. However, there is, as you guys know, there is a lot of algorithmic and bot trading, so automated programs in the market. And when they see that we reach a certain level, they only work with, it's computers, so they only work with numbers. And so when you have this the world's biggest stock index reaching a official bear market territory, I had this very highlighted on my chart because it correlated a lot with, for example, the stock price in Apple and the other broad indices. I was looking for it to bounce because algorithms will come into the market and start trading on certain price action, on certain price levels. And as you can see, this was already highlighted for me, and we got this 1.4% bounce, and actually in aftermarkets even higher. So what am I saying? What do I want to come to with this? Well, what I'm talking about here is that we closed the week below the 100 week moving average. This tells us statistically that we should see a run towards the 200 weekly moving average. So in as fast as in the upcoming week. So when we have had this insane bull run that we've had in the stock index, people and investors become more and more leveraged. You know, leveraged, where you leverage up your position. Now, this means that when this kind of bull run comes to an end, we see this quick deleveraging where people are quickly getting out of their trades. And that is something that we have seen quite a lot, where we see this significant pullback in stock indices. So even though we ended last week on what looked like risk on, due to all of these broader asset classes reaching significant levels, I would view that as temporary bullish bounces due to as I said, algorithms, etc., that are coming into the market. So my preferred take would be on the S&P, that we see it continuing its downward and quite aggressively continuing its downfall towards the 200 weekly moving average. At least the odds are favoring that scenario. That would mean another week with risk off. However, I also highlighted last week that since we've had risk off, the market is quite desperate for risk on, so any positive news will be overinterpreted, and we saw that pretty significantly last Friday. So I'm expecting risk off. I'm expecting the S&P to keep falling. How fast that will happen, only God knows, but I'm expecting risk off with the upside risk of the market overinterpreting positive news. So with that said, let's jump into last week's calls. Now, we had a mixed bag. The biggest winners that we had were that we talked about trading the themes, where I talked about euro weakness and pound weakness, and we got that. And you wanted to pair that towards strength. Now, I talked about looking for oil to break out. We didn't get that. It broke down and just moved back into this consolidation. This pattern still matters. Look for it to break out. If it does, it will take other assets with it in the market. Euro CAD was a good call to short euro weakness against oil strength. Pound CAD would also have been interesting. We talked about euro dollar, which could have also been a good short, but it didn't move that much. So it was really a mixed bag, because on the other hand we had I think it was pound Aussie we talked about, that didn't really, just had a big pop in the beginning of the weekend and it just consolidated around there. Now this is still a nice level to short off. I mean, I like pound short at this point in time. So shorting it off this level could also be interesting, but yeah, that's where we are. So with that said, let me jump into this week's call. So as always, let's start with Bitcoin against the US dollar. So Bitcoin has had a structural change. So we were looking for this bullish move upwards, but if we really zoom this out, if we zoom this in, what I had on the lower time frame was this wedge that I was looking for it to break out and move upwards. Now it didn't do that. Instead of it forming a wedge, we actually formed a bear flag instead. So the problem with this pattern right here is that if we look at this from a structural point of view, where you first have this move and then you have the flag, and then you're going to get another move to the downside from just a structural point of view, that should technically target the 10,000 level. Now, am I saying Bitcoin will reach the 10,000 level? Not necessarily. I'm not calling it like that. If we continue seeing risk off in the markets, then of course Bitcoin will take a hit to the downside. So if you want to trade Bitcoin, it's really to the downside in my opinion. But I don't really have a clear-cut trade on it, because we just peaked back above this support for the week. So as long as we are holding this support right here at 28.55, I don't really see it flushing to the downside. But if we break that, then yes, I would like shorts, not necessarily as far as 10,000, but we talked about this before. If Bitcoin gets going, it can really move fast to the downside. So pair that with the S&P 500 that might break down further. I think it's definitely shorts looking for in Bitcoin at this point in time. Speaking on shorts, let's look at gold. I spoke last week about gold looking heavy, and we continued moving down. We have actually broken the 100-day moving average. We have broken the 200-day moving average. However, gold is looking very oversold at this point in time. It still looks heavy with these big red candles, daily candles, but it's starting to look a little bit oversold. We are very far away from the adaptive moving average. So gold, in trading, you always say that you don't want to catch a falling knife. Gold is kind of the falling knife that I want to catch. The problem with that is that any kind of bull rally that we see in gold could easily see gold target the 1950 level again. So with these breakdowns, with these lower levels that we're starting to move back into, the risk reward is just getting very attractive for it to correct. So I don't want to chase gold lower at this point in time. That's not my preferred trade. I would look for other pairs to trade in that case if you want to trade weakness against the dollar, because fundamentally there's still a case for gold going higher. It's just a case of it being valued in dollars at this point in time. That doesn't really makes it sustainable to hold longs at this point in time. If it breaks the 1800 level and actually closes below it on a daily basis, it's really becoming a dicey one. I don't want to touch it below 1800. But as long as if we can find some support at these levels right here and some indications that we might move higher, yeah, I wouldn't mind a long, lower volume long trade targeting 1950, to be fair. Let me paint that out for you. So a long trade anywhere around here with stops just below 1800, we would have to see a significant close below that. I mean, that's a 5 times risk reward. So yeah, looking attractive from that. Might be the falling knife that you want to try and catch. Just don't over leverage, don't use too big of a position so that you cut yourself if it keeps on falling. So into the last trades of the week, we're looking at euro pound. So with pound, we are having a structural issue from many points from the fundamentals. So you have interest rate hikes that might come and might take the market by surprise. You have stagflation issues confirmed by the Bank of England, and now we have political issues with Northern Ireland, where we might get a trade war with Europe. Now, the market hasn't really started focusing that much on it, because in terms of priorities, the market is focusing more on other geopolitical news and macro fundamentals at this point in time. So I think this could be a good time to get into a macro trade before it actually has really started going. So what I want to say with that is that you are looking for pound weakness, and in that case I'm looking for euro pound strength. As you remember, we talked about this trade a couple of weeks ago where we wanted euro pound to move higher. We got that. It was a great trade. Now, from where we are right now, we are sitting well above the 200-day moving average and the 100-day moving average. We are getting that pullback into the short-term adaptive moving average, where it's starting to correct that overbought territory. So this, from a technical point of view, is starting to look interesting to long again with this correction. So, as I've spoken about many times before, I would go on a lower time frame, look for a momentum trigger for this to get that long trade to the upside. So fundamentals are in place, it's just a matter of finding the technicals. So say that we would find a long trade somewhere around here. We can actually go on a lower time frame to see where do we find support. Well, sorry. Say that we would get the trigger down towards, say, the moving average down here, and we will place the stop against the previous swing low, and then we go back to the daily chart. Just targeting the highs gets you a three times risk reward. Take that. That's a good trade. So, you know, looking for long entries on euro pound, I think that's a good one. Second one, pound JPY, so the British pound against the Japanese yen. I think this is the same thing here. We got the fundamentals in place. We're looking for a technical entry. We want to short the pound against the Japanese yen. Same thing here. We've seen a small pullback. Now the problem with pound yen is that unlike euro pound, we haven't been able to close below the 200-day moving average or the 100-day moving average. So sorry, the other way around, the 100 moving average and the 200-day moving average. So if this would have closed below the 100-day, that would have made me much more inclined to short this now. So that's what I'm saying. Watch the MAs on pound yen if you want to enter it. So, and we are still very far away from the adaptive moving average, so we could easily see this move up towards these regions more before it actually turning lower. So this is a bit more tricky. So the trade isn't there at this point in time, but I'm highlighting it because the macros are there and you want to go on a lower time frame trying to find that entry. So if we go on the 1 hour chart, you have we closed below the 100 hour moving average and the 200 hour moving average. However, we have broken above the adaptive moving average, so that could tell us on the lower time frame that the correction, as we break the adaptive moving average, that correction could be over. So you might want to look for a short trade against the 100 or a short trade against the 200, depending on price action. Either way, you should be able to muster out somewhere around 2 to 3 risk-reward ratio on that, maybe even more on a higher time frame. So pound yen, I like it lower from a macro perspective, but the technical entry isn't quite there yet. Keep an eye out on the moving average. If you liked this market report, leave a comment, leave a like, would be much appreciated. I enjoy doing these. I would like to interact more with you through the comments. So if you have something that you want me to run through on next week, I can do that. Just leave it in the comments. Until then, I hope you guys have a profitable week. Stay safe, guys. Bye bye.